You know, the biggest mistake traders make with market structure is thinking that every higher high is bullish and every lower low is bearish. In reality, price can print higher highs while institutions are distributing, and it can push lower while smart money is quietly accumulating. That's why so many traders end up buying tops and selling bottoms. This is exactly where this indicator becomes important, because it goes far beyond basic swing labels and shows you how price actually moves around liquidity and institutional participation. To use this, go to tradingview.com, open any market, and add the Advanced Market Structure Indicator by Rogman. This works on any asset and any time frame, but the real power comes from understanding what it's showing you rather than just looking at the labels. Most market structure indicators only react after price has already moved. They don't tell you who's in control, where liquidity is sitting, or whether a move is genuine or engineered. This indicator combines swing structure, liquidity zones, session timing, and trend filters into one framework, so you're not analyzing price in isolation. The problem with traditional market structure is that traders treat it mechanically. They buy higher highs, sell lower lows, and ignore where those moves are happening. Institutions don't move price randomly. This indicator makes that behavior visible by showing you swing highs and lows, areas of buy-side and sell-side liquidity, and how price reacts around those levels. Above swing highs, you have buy-side liquidity, and below swing lows, you have sell-side liquidity. These are the areas where retail stops usually sit, and price is constantly drawn toward them. Most reversals don't happen out of nowhere. They start after liquidity is taken. On top of that, the indicator highlights the major trading sessions like Asia, London, and New York, which matters because most meaningful moves happen during London and New York. When structure breaks during inactive sessions, it's often a trap. Trend is also filtered using multiple methods instead of a single signal. Structure direction, moving averages, and trend filters work together, so you're not guessing whether the market is bullish or bearish. When everything aligns, you're trading with institutional flow instead of fighting it. To trade with this indicator, you always start with higher time frame bias. Higher highs and higher lows give you a bullish bias, while lower lows and lower highs give you a bearish bias. If structure is mixed or unclear, you simply don't trade. No bias means no execution. Once bias is defined, you wait for liquidity to be taken. Let's see how to take trade now. For buys, price needs to run below a previous low and take sell-side liquidity, ideally near a session low or higher time frame level, such as daily high-low. After liquidity is taken, you drop to a lower time frame like the 5 or 15-minute chart and wait for a shift in structure. And then you want to see price stop making lower lows, form a higher low, and then break a previous high. That's your entry and take profit at least 1 by 1 or 1 by 2. For sells, price needs to run above a previous high and take buy-side liquidity at session or daily high. After liquidity is taken, you drop to a lower time frame and break in structure is your entry confirmation, not the liquidity sweep itself. Entering before that confirmation is how traders get trapped. Stop losses should go beyond the liquidity sweep, and targets should be set at previous highs or lows, opposing liquidity zones, or daily and weekly levels. If the trade doesn't offer at least a 2-to-1 risk to reward, it's not worth taking. Most losses come from trading every structure label, ignoring higher time frame context, entering before liquidity is taken, or trading during dead sessions. This indicator removes a lot of guesswork, but only if you follow the sequence correctly. Advanced market structure isn't about predicting where price will go next. It's about reacting after institutions show their hand. When you combine higher time frame bias, liquidity, structure shifts, and session timing, you stop chasing trades and start letting trades come to you. If you found this useful, make sure to like and subscribe for more market structure breakdowns, and I'll see you in the next one.